Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research or speak with a licensed financial professional before making investment decisions. Welcome back to Money Mindset, the place where investing finally becomes simple. Today we're talking about one of the most popular topics for beginners and long-term investors: dividend ETFs, and how you can build a portfolio that pays you passive income every single month. Before we start, remember to like the video, subscribe, turn on notifications, and comment which dividend ETF you want me to analyze next. New videos every day. Let's begin with something important. What exactly is a dividend ETF? A dividend ETF is simply an exchange-traded fund that holds a basket of companies known for paying dividends regularly. Instead of picking individual dividend stocks one by one, you get instant diversification, dozens or hundreds of companies paying you small amounts that add up over time. And here's the best part: many dividend ETFs pay out income every month or every quarter, giving you consistent cash flow without needing to monitor stocks daily. But how do dividend ETFs actually generate passive income? It's simple. Every company inside the ETF pays dividends based on its profits. The ETF collects those dividends and distributes them to shareholders, including you. So even if the market is flat or going sideways, dividends continue flowing, creating a sense of stability during uncertain times. Now, let's look at the two types of dividend ETFs beginners should understand. First, we have high dividend ETFs. These focus on companies that pay higher than average yields. Think utilities, telecoms, energy companies, and real estate. The income is attractive, but the trade-off is that these companies might have slower growth. Second, we have dividend growth ETFs. Instead of chasing the highest yield, these focus on companies that increase their dividends year after year, like the dividend aristocrats. These companies may pay less today, but their payments grow consistently, protecting your income from inflation. Now, let's get to what you're really here for: examples of real dividend ETFs that pay regularly. Starting with SCHD, the Schwab US Dividend Equity ETF. SCHD is one of the most respected dividend ETFs out there. It holds high-quality U.S. companies with strong financials and consistent dividend records. The yield is solid, the fees are low, and the long-term performance has beaten many active funds. This is the kind of ETF people buy to build reliable passive income without taking excessive risk. Next, the famous VYM Vanguard High Dividend Yield ETF. VYM focuses on large, stable companies with higher than average dividend yields. It's broad, diversified, and ideal for beginners who want simple exposure to big, mature dividend payers across multiple sectors. Now let's look at something that excites a lot of monthly income seekers: monthly dividend ETFs. One of the most popular is JEPI Morgan Equity Premium Income ETF. JEPI uses a covered call strategy to generate extra income, which is why its dividends are higher than traditional ETFs. The payout is monthly, making it perfect for people building a consistent cash flow portfolio. But remember, high income usually means higher complexity and sometimes higher risk. Another monthly option is QYLD, Global X Nasdaq 100 Covered Call ETF. This one is known for extremely high yields because it sells covered calls on the Nasdaq 100. It pays monthly, but there's a catch: the long-term price growth is low. You're trading potential growth for income, so it's important to understand the trade-off. If you're outside the US or investing globally, you might look at the IGI Vanguard International Dividend Appreciation ETF. This gives you access to companies around the world that consistently grow their dividends. It pays quarterly, but it adds diversification beyond the US, reducing reliance on a single economy. So now comes the big question: how do you actually earn passive income every month? Here's the simple strategy: combine different dividend ETFs with staggered payout schedules, some monthly, some quarterly, so something is always paying you. For example, a mix of SCHD, VYM, and a monthly payer like JEPI, I can create a steady flow of income across the entire year. Some months may pay more than others, but overall you get consistent, reliable cash flow. But here's the truth. Building passive income isn't just about picking the highest yield ETF. It's about balancing three things: income, stability, growth. Too much yield can be dangerous. Too much growth means lower income. The best portfolios blend both and evolve as your goals change. Let's wrap up with the key takeaways. Dividend ETFs give you passive income without the stress of picking individual stocks. Some focus on high yields, some focus on long-term dividend growth. Some pay quarterly, some pay monthly. The right mix can give you cash flow today and long-term growth for tomorrow. If this video helped you understand dividend ETFs better, make sure to like, subscribe, activate notifications, and comment which dividend ETF you want covered next. Thanks for watching Money Mindset, where financial education becomes simple, visual, and practical.